Hi everyone, happy Wednesday. In today's video, I'm going to be giving an overview of the 401k. Hi everyone, I'm Star Tower, your financial fitness coach, here to empower you to become financially healthy and to build and live the life and retirement that you and your family deserve. Welcome to Wealthy Wednesday, where I talk about concepts related to long-term wealth and planning. In a previous video, I talked about how to calculate your retirement number. Now I'm going to talk about some of the ways to build up that retirement savings. And today's video, I'm going to be talking about the 401k as one of the options. The 401k allows these contributions to grow tax deferred until you withdraw them during retirement at age 59 and a half, at which point they incur a taxable gain. If you decide to withdraw it before you turn 59 and a half, it's going to incur a penalty charge as well as a taxable gain. So how much should you put into your 401k? Well, the rule of thumb, best practice, is to put 10% of your gross income. So if you make $100,000 of income before tax, for example, you would want to put 10% of that, which is $10,000 into your contribution. But again, you want to look at your situation, right? Let's say you're trying to save up to buy a new home in short term, or you need to build up an emergency fund, or you need to pay off some high interest debt. You want to look at your situation and see if you have the bandwidth to put that 10% into your contribution. If not, then you kind of want to fluctuate based on where your needs are. But then you also want to take into account the concept of matching. This is where your employer matches your contribution up to a certain percentage. So that matching kind of varies across employers, across different industries and sectors. So I'll just kind of use a very general case study. So let's say an employer says they will match 100% of contributions up to 4% of the employee's salary. So what that means is if you're making 100K a year, the employer will match 4% of that. So that's 4,000. And if you contribute 4,000, they will match 100% of that. So, obviously the best practice here is to max out your 401k. They always say to max it out. So, right, because you're basically getting free money from your employer. If you only put in, like, let's say 3,000, that means the employer will only match 3,000. And you're basically, there's that gap of 1,000 that you're missing out. And how often do you get free money from your employer, right? So, the best practice is to max out your 401k. So basically in this case, the minimum contribution that this employee should make would be 4,000, which is 4%. And in that case, then the employer will match that 4%, which will give you 8,000 in your account, in your account, in your 401k account. Now I mentioned that before that, the best practice was to put 10% of your gross income into your 401k, and that still stands, right? So if you have the bandwidth, put in that 10%. The maximum amount that you can contribute to your 401k this year for 2024 is $23,000. And for those who are age 50 and above, $30,500, and that changes every year. If you have the bandwidth to be able to put that entire amount into your 401k, I would really encourage it, because that creates a tax benefit, right? Because that $23,000 is taken out of your 100k income, which basically lowers the amount of tax that you pay on that income, because your income is lower. Because you're putting 23,000 of it into the 401k. And, I usually take a long-term view to my savings. So I would just kind of dump that entire amount for that year, whatever maximum 401k contribution I could make, into my 401k, and basically learn to live off of the remainder of my income for that year. You should also note that the maximum amount that you can have in your 401k from both the employer and employee contribution for 2024 is $69,000. And both your contributions cannot exceed this amount. So let's talk about vesting. Vesting means ownership, right? So while 100% of that contribution, whatever amount you put into your 401k, belongs to you 100%, the employer contribution may be vested for a period of years before the employer amount belongs to you completely. So there's kind of three types of vesting. There's immediate vesting, where 100% of the employer contribution belongs to you. There's cliff vesting, where the employee is eligible to the employer contribution after a certain number of years with the company. So if there's a 5-year vesting period, for example, the employee can only get access to the contribution by the employer after they've been in the company for 5 years. So if they get terminated or they decide to leave the company in year 2 or 3, say, they are entitled to nothing. And then finally, there's the graded vesting. Basically, the employee earns gradual ownership of an employer contribution. And this might occur at a rate of 20% per year. So by year 5, you get 100% vested interest, right? So what happens is, like, in the first year, you only get 20% of that employer contribution. And in year 2, you get 40%. So if you decide to leave at year 2, you only get 40%. But if you stay till year 5, then contribution by your employer is fully vested at 100%, and everything is yours. By federal law, graded vesting schedules are capped at 6 years. So an employer cannot say that you need to wait 10 years to get 100% of that contribution, because there's a cap of 6 years. I'll talk about the other versions of the 401k. So the 401k is usually for businesses, corporations, etc. And there's actually different versions of 401ks for other employees as well. So the 403b are for public school employees, charities, and churches. And then the 457 plans are for employees of state and local governments and some tax-exempt organizations. And then the thrift savings plans are for federal government and service members. And before we end, I want to talk about the Secure Act 2.0 for those of you who haven't heard about it yet. Basically, it's new legislation signed in 2022 to encourage retirement savings. So what happens is, effective after December 31st, 2024, all new 401k plans will automatically enroll participants upon attaining eligibility, and the automatic enrollment amount will be at least 3%, but not to exceed 10%. I think this is really great because it really does encourage retirement savings, and I'm sure you can opt out of it, but as we looked at in a previous video, the magic retirement number is 1.46 million, and the average savings in retirement that Americans have is like 88,000, so there's quite a gap. So I think this will really help to spur retirement savings. So thank you for watching my video today. In a future video, I'm going to cover other retirement savings vehicles, such as IRAs and annuities. So make sure you subscribe so you don't miss out on this content, and please share with others that you think might find this helpful. So until next time, be good to yourself, and see you in my next video.